Hey, this is Jeff Scott. I planned on doing Apple seasonality. I forgot before I cut off the video, so I'm just going to add this as an amendment, addendum, whatever. As always, this is education purposes only, not to be considered investment advice. Any decisions you made are your decisions alone. I'm just going to talk a little bit about Apple and how I'm going to manage it. Okay, looking here at Apple's chart in HGSI, it's in between its channel. It had a low close doji on Friday, a PSA reversal, a pocket pivot to the downside, and a kahuna to the downside. I'm currently holding a $180 call, so I've got a little bit of profit here, but not a lot. Earnings are out on the 31st, which is Tuesday. After hours, here's the earnings per share growth rate, multiple. Part of me thinks they're going to surprise the upside, especially with Taiwan Semiconductor moving up, and also the fact that they've become so strong and profitable on services. I bet they do okay. So let's take a look at seasonality and see what that says. Now I could look at seasonality in magenta, and what does it show me? It shows me that short term we're in an uptrend channel. We got above the channel and came back in on Friday, and we closed at the lower half of the channel. I'd rather, in an upward trending channel, I'd rather buy on the lower end, lower side of the channel, and buy it when I go and sell it when it gets to the top. So that's good. And you could see that they predict starting on August 10th. So 10 days after earnings, it begins a very strong part, up 9 out of 10 years, averaging 6.57, which would be a 12-point move. So it doesn't have much seasonality in the next 4 or 5 days on this list. But if I was to buy it on the 31st and look to the left, it says 7 out of 10 years up, average of 7%. So that's decent, not 9-1, not 10-0, but there is some opportunity there, perhaps to the long side. If I look at it in seasonality.com, it should be complementary. And here's its channel to the upside. And in their case, the way I did this channel here is actually pulled down to the bottom of the channel. We're in the midst of a strong seasonality period of time from July 17th, August 29th, up 8 out of 10 years, 7.9% return. So I've got two programs pretty much confirming positive seasonality. If I adjust it a little bit for earnings, it doesn't seem to change anything at all. So looking at that, I'm probably willing to hold on to the stock. After what happened the last couple of days, I might want to lock in my profits. So what could I do to keep the stock and protect myself? So I'm going to go into my Thinkorswim, and I'm going to look here. Price is 190.98. So I could buy a put for $190. What that means is with that put, I have the right, but not the obligation, to sell my Apple for $190.98 for $190. So I would lose 98 cents if I did that because I'm a little bit above it. And what does it cost me for that put? It would cost me $3.45. So I would need the stock to trade under 190 minus 345 or 186.55 for me to start making money on that trade or balancing my position. So that's okay because I would then, if the stock dropped to 150, my put would become worth 40 minus the $3.45 that I paid for it. But can I do this in a way that is cheaper so I'm protected closer at the current price? So if I went with a higher price put, that's silly because I have to pay a lot more money. That's not going to do it. What if I sold a call? So they're predicting an 8-point move. So that would get it to 198. So if I sold a 197.50 call for $1.32, the break even on that call is a 198.80. So it's above the expected move. So if I'm lucky, I could sell a call for $1.32 and that would eliminate some of the price that I'm having to pay for that put. So that would cut my put cost down to $2.13. So now I start to get a benefit of 197.87 or 187.87. Now, since my calls are long at 180, if I just want to protect the value of my calls, I could then also sell a put for 182, and that would give somebody the right, but not the obligation, to sell me their stock for $1 or for 182.50, and I'll get paid $1 for that. So if I combine all these three trades together, the buying the protective put, selling the put out of the money, and I'll talk about what that does to my trade, and then selling a call out of the money, I can lower my cost of that protection to 94 cents. So what is that going to mean for the stock? In my mind, think about this for a second. So if I construct this trade, it means I will be at 190, I'll have a put. I will have sold a put against that put at 182.50. So that means I have $7.50 protection to the downside. And then I've sold a call against my position, which means if it goes above 197.50, then I potentially lose. And so the way I look at this trade, and the reason why I like this trade, I don't want it to be red, hold on, is that if it does nothing, if the Apple does nothing and stays within this box here, then I'll make or lose a couple of bucks, plus I'll lose the 94 cents on my trade, and I'll say to myself, man, I didn't really need to do that protection. If it trades between 190 and 182.50, I will be able to protect my stock price down to 182.50 plus the 94 cents, the 183.40. So I'm getting $7 of downside protection for that $1. And if the stock moves up to 197.50, I'll lose the stock. It'll be called away, but I would have picked up $7.50 gain. So to me, for 94 cents, I'm protecting $7.50 of losses. Plus, I'm allowing me an opportunity to get $7.50 of additional gains. And if I've eliminated the possibility that my position will expire worthless, I'll either get it taken away at 182.50, I'll either have coverage down to 182.50 now, or I will have it taken away above 197.50. Now, one thing to point out, because I have this put down here, I will lose money below 182.50 compared to what I am at today. And that's because I'll be protected for 750, and then the valuation of my stock will continue to drop. But since I have $180 calls, not stock, in reality, I'm accepting a loss here of $2.50. I like this trade because I'm controlling my loss. I'm giving myself a chance to make $7.50 to the upside and protect against the $7.50 to the downside. The expected move is only $8, and it cost me less than $1 to do it. So I will put that trade on likely on Monday or Tuesday before earnings. And then if it expires worthless, I lose 94 cents and I stay within this box. I'm happy with that because it means I probably made money on the trade. If it goes up to 220, I'll be bummed out, but I've been more bummed if I sold it at 189 or 190. And if it drops to 174, I'll be very happy that I protected $7.50 for 94 cents, and then I would have lost the last 250 of protection. So that's how I'll probably play it. The seasonality is strong, strong enough that if we weren't in this crazy market, I might not take the protection. But this is what I talked about. I'm protecting my nest egg. I'm not gambling with my kids' inheritance. Joke, joke, joke. And I'll probably put on some protective strategy. Bye, everybody. Hope you find this to be interesting. Send me some feedback if I should talk about options and things that I do, or if I should just stop doing these, or whatever. Thanks, everybody. Goodbye.